When we talk about AI in finance, it's clearly not just another piece of software, is it? It feels like a fundamental shift.
It absolutely is. And what's fascinating really is how AI, especially generative AI, is acting like what economists call a general purpose technology.
Like the steam engine or electricity.
Exactly. Technologies that didn't just solve one specific problem, right? They unlocked this whole cascade of innovation across basically every industry. AI has that same a broad applicability, rapid improvement, and it sparks entirely new ways of doing things, especially in finance. Because at its core, AI is revolutionizing information processing. And that's the absolute heartbeat of the financial system, isn't it?
That makes perfect sense. Finance runs on information.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So, okay, let's start with how AI is this analytical powerhouse, especially prediction. We're seeing Gen AI, like these large language models, LLMs, forecasting, well, everything, stock returns, macroeconomic trends.
Precisely. And there are some pretty compelling examples out there. One study found that using sentiment analysis from ChatGPT-4 on news headlines, well, a strategy based on that could actually yield significant daily returns, especially for smaller stocks, the ones that are maybe harder to track traditionally. And this predictability, this sort of advanced signal, it might even last for a couple of days.
And it's not just a one-off finding.
No, not at all. Multiple studies are showing that LLMs often outperform the traditional statistical models for predicting stock returns, and that's across various global markets.
So it goes beyond just reading the news headlines. I think I saw something about using LLMs to analyze earnings calls and disclosures. How's that working?
Oh, that's a huge area. Yeah. Imagine an AI listening to hours of earnings calls or sifting through thousands of pages of corporate filings. Researchers are using LLMs now to pull out really subtle insights, things like predicting a firm's investment plans just from the language used in the earnings call, or even gauging professional fund managers' underlying beliefs from their mandated disclosures. These AI insights are proving remarkably good at forecasting things like future capital spending or even how funds might trade. It's really moving way beyond simple keyword searches, you know?
And this isn't just micro-level individual companies. It applies to the bigger picture, too.
Absolutely. LLMs are now being used successfully to forecast macroeconomic variables, think inflation, GDP growth. They're even generating quite sophisticated economic uncertainty indices. And some of these AI forecasts, they're actually proving more accurate than traditional methods. But it's important to add a caveat here. LLMs aren't magic wands. They're powerful, yes, but not infallible. Some studies show they can still have behavioral biases, like maybe over-extrapolating past returns. And in certain specific situations, maybe low-data environments, they might even underperform experienced human analysts.
That's a really crucial point. Nuance matters. Okay, so beyond just prediction, it sounds like AI is changing how we even extract meaning from complex text. It's not just counting words anymore.
Exactly right. The older methods, like a bag of words, they basically just counted words, ignoring context. It was pretty crude, actually. LLMs, though, they create these things called vector embeddings. You can think of them like these incredibly detailed numerical maps. They capture the real meaning, the relationships, the nuances within messy, unstructured text.
Right.
So this lets financial economists pull out much deeper, cleaner information from places like corporate filings, the 10Ks. For instance, AI can now automate estimating core earnings from those dense filings or pull out subtle environmental info from disclosures with way more precision than before.
Okay, now this is where it gets really interesting for me. Social media. We all know platforms like Reddit can sometimes move markets.
Yeah.
What's AI telling us there?
Right. Social media is a potential gold mine for AI analysis. Researchers are digging into millions of posts, images too, from places like Reddit's Wall Street Bets. And they're not just looking for keywords. They're analyzing the sentiment, the dynamics, the memes even.
The memes.
Seriously. They found that certain memes on Wall Street Bets could actually influence trading behavior, sometimes encouraging investors to double down on stocks that were already losing.
Wow.
Yeah. And similarly, by looking at discussions on platforms like StockTwits, AI is showing how retail investors change their strategies on the fly based on the information flow. It's like a window into market psychology, but at a massive scale.
Okay, what about risk management? That's obviously critical in finance.
AI is definitely transforming that too. We're seeing these GPT-based risk measures that are significantly outperforming traditional methods. Why? Because they capture implicit risks, contextual information that a human eye or even simpler algorithms might just miss.
Okay, like what kind of risks?
Well, this leads to better predictions of future stock volatility, especially for more nuanced risks. Things like political uncertainty or climate-related impacts. There are even specialized AI systems now, like one called Covenant AI. It's trained on SEC filings specifically to detect potential covenant violations with pretty remarkable accuracy. This ability to just parse huge amounts of complex information gives financial institutions a much, much sharper view of potential risks.
So it's not just analysis. You mentioned earlier, AI is also emerging as an economic agent, simulating behavior, making decisions. That sounds like science fiction almost.
It does a bit, but it's happening. This is a really profound shift. We're seeing LLMs being framed as AI decision makers. Research is showing these AI agents can exhibit pretty stable risk preferences, though they vary agent to agent, and sometimes they show weaker loss aversion than humans, maybe stronger time discounting in certain setups, though their behavior isn't always perfectly consistent, I should add. What's really insightful, though, is that while LLMs might not be perfectly rational in the classic economic sense, they've actually scored higher on rationality tests than humans in certain tasks, like budget allocation. But, and this is fascinating, they're still sensitive to how questions are framed, just like us.
So they're not just cold logic machines. They have some of the quirks of human decision-making. Does that carry over into more complex interactions, like game theory?
It definitely does. We've seen LLM agents learn quite sophisticated strategic behaviors surprisingly quickly. Things like tacit collusion in pricing simulations, where they figure out how to keep prices high without ever explicitly coordinating.
Oh, yeah.
And in classic game theory setups, like the prisoner's dilemma, these AI agents show strategic behavior, even cooperation. Their decisions in games like the dictator game or ultimatum game, they fall well within the range of typical human behavior. There are even simulations using GPT-based agents to model bank runs and the aggregate withdrawal patterns. They looked eerily similar to real-world panic behavior. It offers completely new ways to model financial crises.
Okay, let's shift to corporate finance. How is AI actually impacting how firms perform, how they're organized internally?
Well, the evidence suggests AI investment is a significant driver of performance. Research is showing firms that invest in AI tend to see real boosts in sales, employment, market share. And crucially, this seems to be driven mainly by product innovation, not just cost cutting. AI helps them create new things, new services.
That's a key difference from past IT waves, right?
Exactly. It distinguishes it from many previous IT shocks, which were often more about efficiency. We're also seeing that AI patents, especially those leveraging open source tools like TensorFlow, are proving significantly more valuable than non-AI patents, and their value actually seems to increase over time.
So it's growth-oriented. And
Yeah.
how does it change the company itself, the structure?
It seems to lead towards flatter organizational structures, fewer layers of middle management, perhaps, and a workforce that's generally more educated, more STEM-focused. There's even this interesting idea of an organizational technology ladder. Basically, firms that made digital adaptations earlier, say during the pandemic, found themselves better positioned to then adopt and really leverage generative AI later on.
What about actual decisions, governance? Is AI making those calls yet?
Yes, in some cases. There are models being developed, like one called Alpha Manager, that uses deep learning and has actually outperformed human managers in simulations aimed at optimizing market cap. And in governance, machine learning tools have shown they can predict director performance better than traditional human selection methods. But it also creates new wrinkles, like in strategic disclosure. Firms are definitely tailoring their reports now to be more easily read by machines.
Makes sense.
But some studies suggest that as investors rely more on AI analysis, firms might actually start withholding certain types of information. It's a bit of a cat and mouse game. And we're also seeing the rise of AI washing.
Ah, like greenwashing, but for AI.
Exactly. Companies talking up their AI initiatives and disclosures, but without much genuine underlying investment. That can definitely mislead the market.
Okay, shifting gears again, let's talk investing. Asset pricing, portfolio management. How is AI rewriting the rules of that game?
Oh, fundamentally, it's changing how we understand and predict returns. machine learning models using hundreds, sometimes thousands of financial predictors, they've consistently shown they can significantly outperform traditional linear regression models for stock return prediction. Even deep convolutional networks, just by analyzing patterns in historical price charts, seem able to predict next month's stock returns better than classic momentum strategies.
And what about finding the underlying factors that actually drive those returns? That's like the holy grail of asset pricing.
Right. And AI is opening up new frontiers there, too. Techniques like instrumented principal component analysis, IPCA. They use detailed firm characteristics to sniff out these subtle hidden factors that explain returns. More advanced methods, like conditional autoencoders, are even suggesting that a lot of the return predictability we thought existed might actually vanish once you properly account for these complex, nonlinear factors discovered by AI. We're even seeing things called artificial intelligence pricing models, or AIPM. These use sophisticated transformer networks, similar to what's in ChatGPT, to share information across different assets. The result: significantly lower pricing errors.
And for the actual management side, building the portfolios.
Big impact there, too. Deep reinforcement learning is being applied directly to portfolio construction with really impressive results sometimes. There's one model, Alpha Portfolio, that achieves Sharpe ratios above 2 in simulations, which is, exceptional.
Yeah, that's very high.
And we're seeing machine learning used more broadly to forecast hedge fund performance. Studies are finding evidence of positive net alpha for mutual funds that incorporate ML into their investment process. It's making a tangible difference in actual investment results.
Okay, finally, let's bring it down to the household level. How is AI impacting things like getting a loan or financial advice for everyday people?
This is a really important area, potentially very impactful. In credit markets, for instance, deep learning models are proving better than traditional methods at predicting mortgage risk. And crucially, these AI algorithms are often approving a significant chunk, maybe 15 to 30% of applicants who were rejected by the old model.
So who are these applicants?
Often they're what researchers call invisible primes, perhaps minorities or immigrants who might have thin credit files but are actually creditworthy. The AI can see patterns the old scores miss, so it's potentially a huge step for financial inclusion.
That really does sound like democratizing access. What about financial advice, robo-advisors and the like?
Absolutely. AI-powered advice, mainly through Robo-Advisors, is doing just that. It's lowering the barriers, the cost barriers, the cognitive barriers, even psychological ones that used to keep less wealthy investors away from sophisticated financial management. Research shows these AI consultants don't just improve decision-making quality, they can actually lead to better portfolio returns. How? By helping investors build more efficient, diversified portfolios, and by mitigating some of those common behavioral biases that hurt performance, like panic selling, for instance.
Okay, so we've covered a lot about what AI is doing across finance. It's impressive. But let's dig into the why. Why is this shift so fundamental? What makes AI different from, say, just better computers?
That really is the key question, isn't it? As we touched on, it's acting like a general-purpose technology. That's core. It drives rapid improvement, enables all these complementary innovations. But fundamentally, AI excels at the automation of prediction. That's the framework Agrawal, Gans, and Goldfarb use. It's not just faster calculations, it's about fundamentally enhancing information processing. And information processing, as we said, is the absolute core function of the financial system. For individuals, this automation translates into less friction, lower costs for advice, easier access to credit, like we discussed.
And thinking about the wider economy, especially the labor market, how should we conceptualize AI's impact? It's not just about jobs disappearing, is it?
No, it's more complex. The task-based framework from Esimoglu and Restrepo is really useful here. It helps us think about how technology reshuffles specific tasks between humans and machines, or capital. So yes, AI can substitute for human tasks, that's the displacement effect, but it also creates entirely new tasks that humans can do, and it can augment human productivity in existing tasks. This theoretical lens helps us see it's not necessarily a zero-sum game between AI and workers, it's a dynamic reshaping of work.
Okay, and is there sometimes a delay between adopting AI and seeing the big economic benefits? You hear talk about a productivity paradox.
Yes, exactly. That relates to the idea of the productivity J-curve proposed by Brynjolfsson, Rock, and Syverson. The theory suggests that when a powerful GPT like AI arrives, you might initially see productivity growth lag. Why? Because firms first have to make huge, often unmeasured investments in complementary intangibles. Things like redesigning their business processes, retraining workers, developing new organizational structures.
All the hard stuff that takes time.
Precisely. It's only after these foundational investments start to pay off that you see the big surge in productivity. This could explain why we haven't yet seen massive economy-wide productivity gains, despite rapid AI advances. The full impact might still be building.
Right. This all sounds incredibly promising, almost transformative. But there's always a but, isn't there? With technology this powerful, what are the blind spots? What are the potential downsides, the risks we really need to watch out for?
That's a critical question. How do we navigate the inherent risks? And there are quite a few. One big category is just the methodological challenges with the Gen AI itself, especially in finance research and application. A major one is hallucinations. LLMs can just make stuff up confidently, but falsely.
Right, I've heard about that.
We saw that Air Canada case where they were held liable for wrong info given by their chatbot. Now imagine relying on a hallucinating AI for a major trading decision or risk assessment. The potential for losses is substantial.
That's scary. What about classic modeling problems, like overfitting or seeing the future in your data?
Those are absolutely major concerns, and LLMs can make them worse. Financial data is time series data, right? LLMs trained on vast web data might accidentally learn patterns based on information that wasn't available at the time of a decision in the real world. This leads to models that look fantastic in backtesting but just fall apart when used live. Even fine-tuning the model later can accidentally leak future knowledge into it. Another big headache is replicability. Small tweaks to the prompt you give an LLM or using a slightly different model version. It can sometimes cause performance to just plummet unexpectedly. That makes scientific progress hard, and deploying these reliably in finance, very tricky.
So the models themselves can be unstable or inconsistent. That seems like a big problem for finance, which needs reliability.
It really is. Then there's the alignment problem. LLMs are fundamentally built to predict the next word, essentially. They don't have an inherent understanding of truth or fairness or legal rules. So an AI tasked simply with maximizing profit, if it's not properly aligned or constrained, could theoretically recommend exploitative lending practices or find loopholes for market manipulation. Prompt engineering helps, but it's not foolproof.
And the black box issue, not knowing why the AI made a decision.
Exactly, the black box problem. With many complex deep learning models, it's incredibly hard, sometimes impossible, to understand the exact reasoning behind a specific output. Why was this loan applicant flagged? Why did the trading algorithm sell now? This lack of explainability is a huge barrier for adoption, for regulation, and just for building trust and learning from the models.
And data bias. If the training data is biased, the AI learns the bias.
Absolutely. That's a persistent concern. If an AI is trained on historical data that reflects societal biases, say, in lending patterns, it can learn and then perpetuate or even amplify those biases. This can lead to discriminatory outcomes, even if unintended. Regulators are very focused on this, demanding audits and fairness checks.
Okay, so those are challenges with the models themselves. What about broader system-level risks? Could AI destabilize the whole financial system?
That's the next level of concern, yes. The widespread adoption of AI does introduce potential systemic risks. One is procyclicality. If you have many different AI trading systems all trained on similar data or using similar algorithms, they might react to market news or price moves in the same way at the same time very quickly.
Like herd behavior, but automated and faster.
Exactly. This could amplify market swings, making booms bigger and crashes deeper. Think about multiple algorithms hitting sell simultaneously during stress. It could worsen volatility.
Like a potential recipe for flash crashes.
It's certainly a concern regulators are looking at. Another related risk is concentration. Many firms might rely on the same few large AI platforms or data vendors. If one of those core providers has an error, a data breach, or an outage, the problem could instantly cascade across countless financial institutions. It creates new kinds of too-big-to-fail entities, potentially outside the traditional regulatory net. And then there's the really subtle risk of algorithmic collusion.
Collusion, like price fixing.
Sort of, but potentially without any humans ever talking to each other. Advanced pricing algorithms, through trial and error in the market, could independently learn to keep prices artificially high, achieving a kind of tacit collusion. There's evidence suggesting this might have happened in markets like the German retail gasoline market.
Yeah.
It poses really tricky challenges for competition authorities.
Okay, finally, let's circle back to the labor market implications, but thinking about policy, we talked about job shifts, but what about inequality? Who actually benefits from all this?
That's a critical policy question. Without specific interventions, the economic gains from AI are likely to flow disproportionately to capital owners and maybe highly skilled workers who can leverage AI effectively. This could definitely widen wage inequality. Now, AI can also augment less experienced workers, potentially helping the middle class with complex tasks. So the impact on job polarization isn't entirely clear yet. It's complex. But there's a real risk of what Asimoglu and Restrepo call so-automation.
Social automation.
Yeah, where firms prioritize using AI simply to automate existing tasks for marginal cost savings, displacing workers, rather than investing in AI applications that create genuinely new tasks or significantly augment human capabilities and productivity. Policy, therefore, needs to think about how to steer AI development towards those more beneficial augmentative uses, encouraging innovation that complements human skills, not just replaces them.
So wrapping this all up, what does this mean for you listening to this? How should you think about engaging with this rapidly evolving landscape?
Well, if we try to connect all these threads to the bigger picture, I think the true measure of AI's success ultimately won't just be its predictive power or its efficiency gains. It's going to be about how responsibly, how ethically, and how equitably we manage to weave it into our financial system and into society as a whole.
Indeed. It really underscores that being informed about AI isn't just interesting anymore, it's becoming a necessity. Because ultimately, AI's impact, whether in finance or elsewhere, it isn't predetermined. It's not inevitable. It involves choices. Choices in how we develop it, how we regulate it, how companies implement it, and how you choose to engage with it. So how will you navigate this powerful technological shift now that you have this deeper understanding? As AI gets smarter, will our financial markets just become more efficient? Or maybe more complex, more fragile, susceptible to entirely new kinds of risks we haven't even fully grasped yet? This deep dive aimed to give you the context and the key insights to grapple with those questions. Keep asking them, keep exploring.